Ah, there you are. Okay.
There we
Hi.
go.
It's Michelle Silverman Bedell from Silverson's Realty, and today I invited Harry Bennett from Go Rascal to discuss the differences in financing when buying a co-op, a cooperative, or a condominium. So I just want to just briefly go into one big difference between a co-op and a condominium for the viewers. A co-op, you're buying shares in a corporation and you're not getting a deed, you're getting a stock and lease or a certificate. With a condominium, it is considered real estate, and the financing is, and you get receive a deed when you at the closing. So tell us the differences really when it has to do with financing when you're buying a co-op versus a condominium.
Sure. Yeah, thanks for having me, Michelle. So the biggest thing when it comes to condos and co-ops, on at least on the mortgage side, really is the closing costs. And the reason why is because on condos you have what's called a mortgage tax, whereas
Correct.
co-ops do not. And so as you mentioned before, co-ops are technically not considered real property because you're
Right.
getting a stock and proprietary lease versus a condo, which will have the full deed and title to the property. So when
Right.
you're looking at closing costs, co-ops are much more inexpensive, but also less expensive from a purchase price standpoint. So those are kind of the pros to them.
Right.
But when it comes to the actual closing costs themselves, you'll have a mortgage tax on a condo that can be upwards of 1%, 1.5%, just depending on
Right.
exactly where you're buying. So I think it's just important for, if you're looking between the two, understand that your closing costs are going to be higher, but you're going to have more, liberty with a condo versus a co-op. So,
Okay. So we understand that when you're buying a co-op, also the buyer has to go before the board
right.
to be approved, right, or not approved, and they also may have to put more money down per post closing. So that's an additional expense on the buy side for a condominium, for a
Right.
co-op rather. But when you're buying a condominium, there are other concerns, even though you don't have to go before the co-op board. The condo has to approve you, right? You have the right of first refusal whereby they can buy it back. Usually they don't, but they could. The condo can. But you have some other concerns, right? When you're dealing with a condo and in terms of financing, what would those concerns be?
Yeah. So, I mean, there's kind of a standard checklist that a buyer should know as well as their agent when they're going into making
Right,
an offer on a condo. And when I say a checklist, I'm referring to Fannie Mae and Freddie Mac. Those are the two
right,
government-backed agencies that produce the mortgages in our market today. And so they have a very specific list of what they consider what's called warrantable condos or approved condos, qualified
right,
condos. So those five, so to say, the big five, number one is single entity ownership. So if there's a sponsor, let's say, or just an investor in the building that owns more than 10% of the total units, that
right,
can raise a red flag. It doesn't mean you still can't get the place, but it's just something that banks will look at, right?
right, right,
So that's number one. Number two is investor concentration. So to go along to that point, if there's one specific, let's say, landlord or investment group that owns more than 35% of the total units, that
right,
can also, raise some flags as well. So two big things right off the bat that you want to look at. The third one is litigation. So if there's any active lawsuits that are going on, that can be a deal breaker. However, it does depend on what kind of litigation it is. And I'll give you a quick example.
right.
If you have, like let's say like a minor slip and fall case where somebody was walking in front of the condo and
The
they're now
building,
suing the building, right?
right,
If the insurance can cover something like that in terms of damages and they can write a letter, the insurance company can write a letter stating that, then you're not going to have an issue getting approved for financing in that building. When it
correct,
becomes a little bit more of that red flag that I mentioned, it's more of a litigation when it comes to structural damage. If something major with the building where maybe something fell on someone and it was like it was obviously a
like a
very bad
terrace, right,
situation. Yeah.
right,
Or just something like a wall fell down or God forbid
right.
something happened within the building. Banks are naturally going to question that, and it's going to become more difficult to find an option. So that's the third one. The fourth one, I'm just looking at my notes here, less than 10% in reserves for a budget. So every building, condo and
Right.
co-op have to have a certain allotted amount for their budget per year. And
Right.
if it's less than 10%, banks are going to question that. The last thing is if you get into a situation where, let's say you find a condo and there's a lot of residential units, but there's also maybe a commercial aspect to it. So maybe the bottom floor is like a bunch of
Or
shops or a
commercial.
gym, commercial
Right.
spaces. Banks typically want to see the commercial square footage to be less than 35% of the total square footage. So those are the five main points when it comes to what Fannie and Freddie will consider qualified condos. But again, as a broker, I'm able to get around that if it needs to, if you need financing for it.
Okay, what happens in a condominium? There are delinquencies in terms of people stop paying their, or they're just really backed up on their paying their common charges, for instance, not maintenance, it's condos, common charges. If there's a delinquency or there's a high rate of delinquency in that building, would that also be a red flag to a lender?
That also goes back to the budget as well, because if the budget is strong enough, they can kind of offset the delinquency from some of the paying unit owners to still get them an improved status. But that is something to look at. If you're buying into a building, you probably don't want to be buying into a building where someone's next to you is not paying their dues, right? I mean,
Right,
or
right.
something to think about at least. So
So it's very important that the attorney, as also I guess the bank, really reviews all the financials historically, even going back. So we usually ask for the last 2 years of financials. Some people may request 3 years just to really have the history of the building, especially if it's not brand new. And with condominiums and even with co-ops, right? We always ask for the bylaws, the last 2 years financials, the prospectus. So the buyer going in will really have a good understanding of the history of the building and what's happened in it. And also from a financing point of view, they also you would have an understanding of if this is a financially sound building, correct?
right.
And I also think with a co-op, what we tell our buyers to always make sure that lender will lend in that building, even before you start getting your hopes up and filling out the forms. Make sure that that lender you've chosen is is able to lend in that building.
Right. I always say, to my clients as borrowers, as well as my realtor partners like Michelle, it's important to vet the building beforehand, like you said. So if you're able to say that you're going to target X, Y, and Z on Main Street, give me a call. Let me know what building it is, what you're looking
Right.
to pursue, and I can check my database in less than 10 minutes to see if it's already approved. Because if it is, we're good to go. We can breeze through the process for the most part. Or if it's not and there's some concerns, I can get in front of it. And by getting in front of it, it's just a matter of making sure that I get as much paperwork as possible from the condo. And like you said, Michelle, attorneys will do their due diligence. The lender also has their side of that diligence and underwriting. And so in order to get that, the best things to do are actually to get the paperwork up front. And that is the condo questionnaire is number
We do
one
our
for
own.
for
Right.
any yeah, for any lender. And it's good to understand too, because unfortunately you have to pay for every questionnaire if you're a buyer going in, right? The management company does charge you typically every time you request one. And so the attorney has their own questionnaire and then the lender has their own.
And we
So,
have our own.
and yeah, exactly. So there's sometimes a few different charges, but look, it's one of the biggest investments probably of your life. A couple $100 extra to make sure you're doing the due diligence. It's part of the process, and
Well,
you're gonna
we
feel a lot better.
Right. Well, we do all our own due diligence with Coops Condos, which obviously we request the prospectus. We do our own questionnaire, which may be similar to yours or an attorney.
Right.
And we always ask for the bylaws, the application up front, and the last 2 years financials, and any other things going on in the building that we should know about. In terms of processing time, do you see a big difference between a condo and a co-op in terms of the amount of time it takes you to close?
I don't think there's really much of a difference on the lending side. So my side of it, it's relatively the same process. It usually takes a few weeks to get the management company to give us the right amount of information, and then we can
Right.
review it and approve it. The biggest thing, as you know, Michelle, is just the board itself, right? With condos, they tend to move a lot quicker. You don't always have to go through a rigorous board interview and board application, whereas with co-ops, that tends to be a little bit more of the case. And when you have that, the timeline tends to spread out more on co-ops. But from a lending side, to answer your question, which is a really good one, it doesn't make a difference on which type of building. We're still going to produce these commitments in a few weeks or less if needed. So
Okay, so I think this is all really good information. In terms of a co-op, going into the summer, we always have to be concerned about vacation time
yeah,
because you want to be on that roster, with the calendar. But sometimes during the summer, things are slowed down. The same with holiday time. So I think a buyer should take that into account when they're buying their property. Seasonal kind of difficulties as well. But I think that you seem to be very knowledgeable about co-op and condo lending. And I think it's very important because often people choose people and they're not that well versed in the issues that could arise in the buying and selling process. Especially if they're buying one and they're selling another property, they have to coordinate their funds. So having
right.
said all that, I want to wish you a great day, and I look forward to seeing you again at the
You as
next
well.
meeting or soon.
All right, sounds good. Thanks so much
Be
for having me,
well.
Michelle.
Bye
Take
bye.
care.
Be well. Bye bye.